Welcome, sir.
Yeah, what happened to your FR class? Tell me.
The network was quite unstable. So we advise the lecturer to upgrade his network so can have a meaningful class.
But the truth is that the guy said he won't be taking the class now. He's
And
not
that was the
Ibrahim.
conclusion later. Yes.
He said he won't take the class now, and that's all right. Sorry, we are starting behind schedule. Of course, we started the SFM late, like to 9, so that affected my. In fact, what happened was that the secretary thought we were having physical class. She was already on her way to VI. All right, albeit everything happens according to God's plans. Our minds are waiting today at VI. But here we are having lecture in our various homes, at the comfort of our homes. Precisely today, we are looking at budgets and budgetary control. Under this topic, we shall be looking at what is budget, the purpose of budget, the terms used with budgeting, the types of budgets, and how to prepare budgets. What is budget really? Regardless of the size of a company, the nature of the company's products, the complexity of the company's processes, there must be a budget. There must be something the company is planning to achieve. Even as an individual, there's something we plan to achieve at every point in our life. It is not possible that somebody will be walking on the surface of earth without a purpose. The second thing is that purpose, is it godly or ungodly? Is that purpose reasonable or unreasonable? But there must be something we point to achieve at every point of our life. The same applies to a business entity. There's a purpose for establishing a company. And to meet that purpose, there must be a plan on how to achieve it. This plan will involve money. And this money will be expected to return, to give us return. Now, what is budget? Budget can be defined as plan expressed in financial terms. Budget can be defined as plan expressed in monetary terms. When you say budget, as soon as, of course, you have different plans, you have different alternatives you are trying to achieve. You have your plans on what you want to achieve. As soon as you introduce money to your plan, that becomes budget. Budget is defined, excuse me, please, as plan, a formal plan expressed in monetary terms. Given a company will have different plans on how to achieve a particular objective. As soon as you introduce money to each plan, that becomes budgets. purpose of budgeting? Why do companies need to do budgets? Why do we need to draw budgets? What are the purpose, or what is the purpose of budgeting really? The purpose of budgets include one, budget is a means of translating companies' objective, long-term objective, into achievable short-term plan. Budget is a means of translating a company long-term objective into short-term achievable plans. Point number two, purpose. Budgets can be used to coordinate the actions of the various departments in an organization. Budgets can serve as the instruments for coordinating the various activities of the departments in the organization. Please let us mute. Let's check our speaker and mute. Budget can also serve as a means of communicating company's plan to the individual managers and other employees. Budget can serve as a means of communicating the company's plan to the individual managers and other employees who are to put the plans into action. We can use budgets to motivate managers and employees, because budget will tell you what we plan to achieve at a specific point in time. So budget can be used as an instrument to motivate managers. You are aware that this is what you need to achieve. Then you'll be motivated. Of course, the budget is documented. The budget is approved by the company's management. You are now aware that if I'm able to achieve this target, this is a basis for what? Performance evaluation. Employees and managers will be motivated. Budget also helps us to identify areas of responsibility. Remember, budget will cover all the company. Budget will cover all the company's activities. So within the budget, I know my responsibility. You know your responsibility. Finally, budget can be used as a benchmark against performance measurements. We can compare actual performance against expected performance. We can use budgets to measure performance. Lastly, budgets can be used to control cost. Our budget will tell us the cost we are expected to incur. Each department will know that, okay, this is the cost management has given me the opportunity to incur. Budget can now be used as a means of cost control. Any question? No question, yes. We have defined budgets. Of course, there should be budget manual. The budget manual is a book, so it's always available in company. The key objective of our budget will be there. The planning procedure and the timetable. Please note, budget must have a time frame. Then there must be approval process. If a budget is not approved, you can't act with it. There must be executive approval, and there's what we call approval process. We have principal budgets. What is principal budgets? Sorry, principal budget factor. We are looking at terms. We have budget manual, principal budget factor. Your principal budget factor is the key budget factor. When we say principal budget factor, it is that budget factor that will limit. Please, can we mute? You can do your talking, but just mute your speaker. The only time your speaker should be up if you want to talk to us in the class. The principal budget factor is that factor that will limit the company's profits. Just like saying limiting factor. The principal budget factor is the factor that can limit the company's operation. In most cases, the principal budget factor is the sales budget, the sales demand. What can limit a company's profit is usually the volume of sales. In most cases, the principal budget factor is the sales budget. And if you are required to prepare budget, in a practical terms, the first budget you are going to prepare is the sales budget. In reality, if you are trying to prepare company's budget, the first budget the company will plan, will draw, is the sales. What are we targeting to sell? What is the quantity of our products we are targeting to sell? That's your sales budget. If you look at the online class, this online class, we have capacity to accommodate 100 students. But number of students on the online class, just 34 students. That means the number of sales demand we have, only 34 students are subscribed for this online class. And our profit will be limited to just 34 students. The sales budget is the principal budget factor. That budget factor that can affect the company's income. All right, we have explained budget manual. The budget manual is an handbook that guides every individual on the budget process. The budget manual is an handbook available in the company that provides guidance to every individual involved in the budget process. The budget manual will tell us the objectives of the budget, the planning procedure and timetable, instruction about details budget, then the details of budget approval. We have explained the principal budget factor. Our next discussion, the various type of budgets to be discussed. One is functional budget. What is functional budget? Your functional budget it's also known as operational budget. Functional budget is also known as what? The operational budget. Budget that is prepared according to the function of the department. This budget is peculiar to manufacturing firm. Functional budget. Budget that has to do with operational budget that affect operations. Our operation will involve sales, production, material purchase, material utilization, labor, and so on. Budget that covers particular aspect of the firm operation. Under the functional budget, we have the sales budget. Your sales budget is prepared in quantity and in naira value. Quantity we plan to sell and the expected selling price per unit. When you are done with your sales budget, you can now prepare production budget. Your production budget will show the quantity we plan to produce, the quantity the company plan to produce. At this point, let me show you how production budget will look like. Let me show the class because you are going to require this. I'm going to share a whiteboard now. Okay, confirm you can see my whiteboard.
Yes, sir, we can.
Okay. We shall show how to a specimen of production budget now. Or a sample of production budget. A sample of production budgets. How it's going to look like. Your production budget. Okay. Production budgets. Some of us, we don't like online class. Why? You start with your plan sales. Plan sales in units. You have your X plus desired closing stock, desired closing stock, no, closing stock, you add this, minus opening stock. Opening stock. You are going to less this. This will now give you production budgets. Production budgets before rejects. Before rejects. Rejects. In some question you may have rejects. In some question you may not have rejects. You now come to production rejects. Production rejects. In brackets, if any, had it, plus production rejects if any, plus add this figure, you now have your total. This will now give you your production budget in units. Budgets in units. Is that clear, please? This is how to handle your production budgets. If you are done with the production budget, the next budget under functional budget is our material purchase budget. Our material purchase budget. Look at it. Material purchase budget. Your material purchase budget will show the quantity of raw material purchased and the naira value of material to be purchased. Your material purchase budget will show the quantity of raw material to be purchased for production and the naira value of the raw material to be purchased for production. I'm coming back to it. I'll come back to it. Your material purchase budget will show quantity of raw material to be purchased for production. Then you now have the naira value of material to be purchased. Let us look at the sample of material purchase budgets. A sample of material purchase budget. Material purchase budget. If you have to prepare, look at the sample. You start with your plan production. Plan production. in units plus desire closing stock of raw material. We need to put this there. Of raw material. Add it. Minus opening stock of raw material. Opening stock of raw material. Minus. This will bring brackets. You now have material purchase before wastage. Material purchase before wastage. Some question examiners will say there's wastage. Some examiners will say there's no wastage. Okay. This will give you a figure. Move down small. Now come to plus anticipated wastage, if any. That will now give us total material purchase, total material purchase budget, either in units or in kg. We have to we have shown sample of production budget. We have shown sample of
Mr. Suwaji, please, can you put the formula clearly on the screen? You moved it up too much.
Don't be annoyed, sir.
Thank you, sir.
Where is the cost of sale? So I will say no wise. Just like, are you copying it?
Yes, we're copying it.
Okay, but it's fine. You can copy, but after the class, we are still going to share. You can copy. It's fine. It's fine. At least. People are supposed to this online class. The wala is much. Okay, sorry. All right.
So that's why we like physical classes.
That's why you like it, not we. But it's fine. We can't afford to just shut down the whole day because the wala is too much there. Are you done copy?
Yeah,
please.
you can screenshot it now and copy and get it later now.
We are still going to share itself after the class.
Okay, sir.
So whether you copy or not, we are still going to, whatever we do, we are still going to share with the class.
All right, sir. That's great.
Expenditure budget. It could be labor expenditure. It could be overhead expenditure, depending on what the examiner wants you to prepare. Maybe labor cost expenditure, maybe overhead expenditure, depending on what the examiner wants you to prepare. That is functional budgets. Rolling budget, also known as continuous budgets. These are budgets which are continuously updated throughout the financial year. This budget will be updated throughout the financial year, depending on the time frame. If you are doing quarterly budget, you want to do quarterly budget, quarterly rolling budget. That means you are going to prepare budget for the first 3 months, January, February, March. When we are done with January, we are going to remove January and add April. It becomes February, March, April. When we are done with February, we are going to delete February and update with May. It becomes March, April, May. This is what we call continuously updated budget. This is rolling budgets. Is that clear, sir?
Yeah.
So when you say rolling budgets, you are going to look at the time frame. A budget must have a time. If you are doing quarterly budget on a rolling basis, that means you are going to do budget for the first 3 months. January, February, March. When you are done with January, you delete January information, update it with April information. You must maintain 3 months. February, March, April. You continue like that until the end of the financial year. That is rolling budget. I've explained again now. Adetayo, rolling budgets. Budget that is continuously updated throughout the financial year. Zero-based budgeting. Zero-based budgeting is a budget that assumes that all activities are assumed to be zero expenditure, until the budget holder justify the need for the expenditure. Zero-based budgeting is a budgeting technique or budgeting systems in which the budgeting will start from zero level. All activities will be assumed to be zero until you justify the expenditure you want to spend. You are going to justify every penny spent. If you want to, if you are using labor budget, we are going to assume that labor budget is 0. That's okay. How many employees do we require? What is the labor cost per employee? We are going to justify number of employee required, then labor cost per employee. We now start building the budget. From zero level up to the last point you want to reach. This kind of budget will remove inefficiency. Zero-based budgeting will eliminate inefficiency and budget padding, because we assume that you don't have any expenditure yet. The budget holder, who is the budget holder? Departmental head will now go and justify why he or she, or why the department required to spend money. Until you justify the amount, no budget will be given to your department. Like I said, it will remove inefficiency. It will avert wastage. It increases motivation, but it can be very costly. It involves a lot of paperwork. I'm going to consume extra time. Incremental budgeting. Incremental budgeting system is a budget that is developed or prepared for next year by adding certain percentage to the previous year's budget. Incremental budgeting is a budgeting system or budgeting technique that is prepared by adding certain percentage to the previous year budget or to the current year actual figure. What we are saying is, maybe last year, 2023, our budget was 50 million. If I now want to do budget for this year, I'll now say, okay, let me do incremental budgeting. Let me add some percentage to last year figure, maybe 20% or 30%. If last year I spent 50 million, this year I should spend 70 million. That is incremental budgeting system. This is what we do in Nigeria. Check government budget. Every year they will increase it. That incremental budgeting system is very easy to prepare. It's very cheap to prepare, but it can create inefficiency. It can give room for wastages, wasteful spending. It can give room for budget padding, because nobody is justifying anything. Next, top-down budgeting system, TDB, top-down budgeting. It means that senior management will prepare the budget for the company as a whole. It means that the management staff prepare budgets for the company, and the budget will be given to employee for what? For execution. Top-down budgeting system. If you have top-down budgeting system, this budgeting system do not create room or does not create room for employees' participation. And the employee that are supposed to act on the budget are not involved in the budget preparation. Their opinion is not involved, or were not taken into consideration when doing the budget. It is very likely that such budget will fail because employees will not be motivated to work towards it. There is the likelihood of resentment from the employee. Then we have bottom up. It's a budgeting process that starts from the lower level. The low-level manager will prepare the budget. They will send the draft to the senior manager for approval and input. The low-level managers that are supposed to implement the budget, they will prepare the budget. It's coming from top up. This kind of budget is likely to be successful. Although employee might try to reduce their budget too. Then periodic budgets. This is budget for the financial year end because all budget must have a period. Actually, your periodic budget is the fixed budget. The periodic budget is the fixed budget. The fixed budget. When we say fixed budget, the fixed budget is the original plan of the company. It is that budget that is not designed to change. The original plan, what the company originally intended to achieve, is our fixed budget. This budget is not designed to change. It's fixed. Please note this. Next. Activity-based budgeting. Activity-based budgeting is simply budget prepare using activity-based costing method. Activity-based budgeting is budget prepared using activity-based costing technique. The same way we treat activity-based costing, the same way we are going to treat activity-based budgeting. Uncertainty in budget. The truth is that if you prepare budget is what the company plans to achieve at future period. Budget is a plan to be achieved at future period. Nobody is 100% certain of future. That means there's some uncertainty in our budget. Uncertainty in budgets because estimate and forecast may not be 100% reliable. We are forecasting sales next year. We forecast our sales for January next year, February next year, March next year, up to June next year. There's no guarantee that we are going to make that actual sales. Our forecast may be based on unreliable information. Management must be aware of the risk and uncertainty when preparing budgets. There's some level of uncertainty, and management must find a way to minimize the risk, the uncertainty. How do we manage uncertainty in budgets? How do we manage uncertainty in budgets? We can do what we call flexible budgets. It's a way of managing uncertainty. Flexible budgets is one of the ways you can manage uncertainty in your budget. Remember, we said the fixed budget is the original plan of the company that is not designed to change. But we are not sure. Let's take, for example, let's look at Dangote Cement. Dangote Cement is preparing budget for 2025. The first thing management we ask is, okay, what is the sales budget for cement? What are we looking at next year to sell for cement? Let's assume Dangote say, okay, that is Dangote Cement as a company, so okay, you want to try and achieve 1 billion sales of bag of cement. We want to achieve 1 billion sales of bag of cement. That 1 billion sales, that becomes the budgeted sales for 2025. 1 billion bags of cement. The next question is, what are we going to do? We must produce at least 1 billion bag of cement. What raw materials do we require to achieve production? They will now direct that to the production director. If you are to produce 1 billion bag of cement, what is the raw materials required? What is the labor required? What is the overhead cost required? The production manager will prepare his own budget based on 1 billion. And that is how the budget will be going until the budget will go throughout the whole department. So the original budget is 1 billion sales. But Dangote Cement is aware that there is no guarantee that we are going to make these sales next year. Or it's also possible that the sales will even exceed 1 billion. To manage uncertainty, Dangote can also prepare a flexible budget. This budget is prepared along with the fixed budget on different assumption, on a different assumption. Management can say, okay, let us look at flexible budgets for 800 million bag of cement in case we cannot meet 1 billion, or 1.2 billion bag of cement in case the demand for cement is above 1 billion. The company will now prepare two flexible budgets based on 800 million bags, based on 1.2 million bags. The two budgets will be prepared along with the fixed budget. That is flexible budget. Budget that is allowed to change. Budget that we can make revise to later. You can also use probability and expected value concepts to manage uncertainty. Recall under investment appraisal, risk and uncertainty. You can use probability concepts and expected value concepts to manage your uncertainty. You can use your sensitivity analysis to manage uncertainty. We can carry out a sensitivity margin, the extent to which some variables are sensitive. We can subject the budget variables to sensitivity analysis. We want to know which of these budget variables are highly sensitive. We can assume that if there is change in selling price, maybe the projected selling price is 100 naira per bag of cement. Our budgeted selling price, that if you are going to sell cement next year, our budgeted selling price should be 100 naira. We can now text the extent to which this selling price is sensitive. We can conduct sensitivity analysis. We can also, okay, what happens if there is 5% reduction in selling price? What will be the impact on our budget? You are now carrying out a sensitivity analysis of the budget variables. You can do that. And you can conduct stress tests. Okay, that's all. Now went to question. Okay, we can stop it there. But we still have financial budget too. We are still going to discuss financial budget. Let's discuss it. Let's discuss it before we go to question. It's not very long. We have explained different budgets. We now have financial budget. Under your financial budget, you have your cash budget. What is cash budget? Your cash budget will show expected cash inflows and expected cash outflows. Your cash budget. Your cash budget will show the expected cash inflows and the expected cash outflows. If you are required to prepare cash budget, please note these 2 points. If you are required to prepare cash budget, please note these 2 points. Point number 1, cash budget will only accommodate cash items. Cash budget will only accommodate cash items. That's point 1. Point number 2. You must pay attention to the timing of the cash receipts or cash payments. You must pay attention to the timing of your cash receipts or your cash payments. For example, if you make sales in January and you are receiving money in February, if you are trying to prepare cash budget, that money will be documented against February receipts. That is cash budget. Your profits, budgeted profits or loss accounts. Your budgeted profit or loss account is prepared on accurate basis, accurate concept. Unlike cash budget is prepared on cash basis. Then lastly, your budgeted balance sheet, that is budgeted statement of financial position. It is prepared in the same way as normal balance sheets. But remember, it's a budget, it's based on budgets. The assets is based on budgets, liability is based on budgets. Right. We are done with the explanation. Any question, please? Jennifer, any question? Who again?
No, sir. Okay.
Aisha, any question? Christopher, Adewale Kehinde, Tope, any question? Black Moses.
Good afternoon, sir.
Any question, please? Roots, you are not online. I can't see you. Governor, where's the governor, sir? All right, if there's no question. Emilade, okay, I'm sorry. I'm used to calling you governor name.
So I'm here.
All right, let's look at illustration 1. Let's look at illustration 1. All right, let me read.
Hello, sir.
Limited. Yes, okay, we are listening.
So what the question you're about to solve now, for we that are having the physical pack, on what page can we find it?
Okay. On the study pack, I don't have study pack at all, but it should be there. I'll check.
Illustration 3. It's illustration 3.
Illustration 3, page what, please?
Page 128 on the hard copy.
God bless you. Page 128, illustration 3. The hard copy, page 128, illustration 3. All right, let's go to it.
Since sir, thank you.
Yeah, we thank the lady. Eco Limited is a small manufacturing company producing high quality products called K and Lay. Both products use raw material tea costing 30 naira per kg in their manufacture. The directors are reviewing the company's stock management policy for the forthcoming year as part of the annual budget preparation cycle. Due to the production specification, quality is an important factor, and a quality control inspection takes place immediately after the production cycle has ended. That means inspection will take place after we have complete production. At this point, any inferior products are rejected and only good production becomes available for sale. In addition to these losses, a certain quantity of waste is unavoidable for material tea due to the cutting process for both products. The following forecast information has been extracted from the departmental estimate for the year ending 31st December 2020, the budget period. Look at the information. We have the product K, product Lay, says quality approved units, 23,000 units, 10,000 units. Finished goods stock increase. That is, the closing stock will increase by, for product K, 275, for product Lay, 185. Post-production rejection rate, 2% for product K, 3% for product Lay. Material tea usage per completed units, net of tax, net of wastage, 2 kg, 3 kg. Material tea wastages, 5%, 10%. Additional information. 1. Usage of raw material tea is expected to be constant throughout the period. Please note, if the examiner says material usage will be constant, what it means is that the opening stock is the same as the closing stock. Hello? Where the question says material usage is constant throughout the period, what it means is that your opening stock and closing stock must be the same. All right. Annual cost of holding 1 unit of raw material stock, 17% of the material cost. Cost of placing order, 30 naira per order. The co-limited maintain a constant 1,000 kg of safety stock. Safety stock of material, regardless of the quantity order. That means opening material must be on 1,000, closing must be 1,000. Next, requirements. Prepare operational budget for the year ended 31st December under the following headings. Show your workings clearly. Production budget for K and lay in units. Purchases budget for material T in kg and in value. Then calculate the economic order quantity. Calculate your economic order quantity. All right. I'm sure we can move to the whiteboard. Let us go to the whiteboard. Let us take a new whiteboard. I'm coming, please. I'm going to share now. Please hold on. After my system. Okay. Let me share this whiteboard. Please confirm you can see my whiteboard being shared.
Yes, sir.
All right, let's go to it. We are required to prepare.
Yes,
A1.
you can see it, sir.
A1, we are to prepare production budgets. Production budgets. For the two products, the products are the products we have K and we have lay. To prepare production budget, you start with your planned sales. Planned sales in units. Look at the question. Says quality approved units for products K 23,000. For products lay 10,000. I'll pick this 23,000. 10,000. I will add closing stock plus desire closing stock. Please, desired closing stock of finished goods. I need to put that there. Of finished goods. It wasn't included in that sample, but it needs to be there. Because you can have closing stock of raw material. It's different for closing stock of finished goods. Go to the question. The examiner says finished goods stock increased by year end. Ordinarily, our closing stock will not change, but there is going to be an increment to it. We now take the increment. 275, 185. I'll come here. 275. 185. I can sum these two together. Sum, please. Okay, this is direct anyway. 23, 275. 10, 185. In this question, there is no opening stock. There's no opening stock anyway. There's no opening stock. So opening stock is assumed to be 0, nothing to be less. You cannot close this. This is your, don't even close it. This is production budget before rejects. Production before rejects. Then plus production rejects. In this question, we have production rejects. Look at the question. Examiner says, yeah, post-production rejection rate, 2%. For product K, 3% for product lay. That means, examiner say post-production. After production, we expect 2% of product K to be rejected. That means our total production is 100%. If 2% is rejects, that means we are left with 98%. Is that not, please? Hello?
Yes, sir.
I will take that again. The total production we are going to achieve is 100%. If examiner says 2% is rejection, that means
exactly, sir.
That means 98% is the good output.
For product K.
Yes, for product K. Is that clear, please?
Yes, sir.
Okay. If you now go to that adjustment now, if I want to get for, I'm not saying show you're working. For product K, if I want to get the rejection rate, I can come here. Let me come here small. Because of space, where is this? Let me come here small. Working. 1. For products K, if I want to get the rejects, that is equal to 2/98 multiplied by 2327. 2,775. This 98%. This is 98%. 23,275 is 98%. 2% of it is reject. 98 plus 2% will give me 100%. The 100% is the total production that will include reject. Hey, please mute. Oh. Please, we cannot compute the reject now. 2 over 98. We cannot compute the reject now. 2 over 98. We cannot compute the reject now. 2 over 98. Please, plus admin, you are completing this class. Plus admin, you are completing this class. Oh. Please compute reject for K. Reject for lay.
475.
What do you have here?
475.
475.
475. Reject for lay. Examiner says 3% is post-production rejection rate. That means 97% is the good production. That 97% is equal to 10,185. I cannot do like this. For lay, this is equal to 3 over 95. Sorry, 97. 3 over 90.
97.
3 over 97 multiplied by 10, 185. What do you have?
315.
You can now go back and add it to it now. This is 475. This is 315. Therefore, total production budget in units, this will give you
33750. 750.
This will give you
10,500.
10,500.
You are done with requirement A. A1. This is units. If you want to test, if you compute 2% of 23,750, it's going to give you back, it's going to give you back 475.
Yes, sir.
You are done with A1. We now go to A2. A2. Material T. Purchase budgets. Material T purchase budget. We can underline this. Our products, we have 2 products. K and lay. To prepare production budget, I'm going to start with my plan. To prepare material purchase budget, I will start with my plan production. Is that not, please?
Yes,
Plan
sir.
production. In units. Here we are going to produce 23,750 as computed above. 750. Here we are going to produce 10,500. Is that not, please?
Yes, sir.
Yes, it is.
All right. Before I go on, please, I need to draw attention to something. There's something that was omitted here. Not deliberate. There's supposed to be a figure here. I will adjust it now. I want to put something. Okay. It was omitted. I don't know. When you get to this place, multiply by material require. Per units. Please, I'm going to make a small adjustment to this. When you get your
Under material
production
unit.
Yes. I'm going to adjust it here. Look at it. When you get your plan production in units, you now come here, multiply. Let me write in words.
Multiply by.
Multiply.
No, sir.
Multiply by material required per units. Let me take that again. Because I've omitted it there, I'm trying to explain it gradually now. When you get your plan production in units, you know, we are trying to prepare material purchase budgets. You now multiply it by material required per unit. If you go back to this question now, look at the question, please. Material T usage per unit, per completed units. To produce a unit of product K, we require 2 kg of material. To produce a unit of product L, we require 3 kg of material. I will now come here. I will multiply this by 2 kg. I will multiply this by 3 kg. When you multiply, you are going to get a figure. That is 47,500. Total material required. Total material required. That means for me to produce product K, I'm going to produce 23,750. And to produce 1 unit, I require 2 kg of material T. Total material required for K, please multiply.
47,500.
This will give us
47,500.
47.
Yes, I'm going to write it. 47,500 kg. Not unit, it's kg. I will close this now. Multiply 10,500 multiplied by 3. I will require
500.
31,500 kg. Thank you. So the adjustment we need to note is that when you pick your plant production in units, if you are calculating material purchase budget, you start with the plant production in units, multiply it by material required per unit. That will now give you total material required. You can now continue. You can continue. Add plus desire closing stock of raw material. Of raw material minus opening stock of raw material. If you go back to the question, examiner says, in this question self, we are told that material usage of material A is expected to be constant throughout. Look at the last note. A coal limited must maintain a constant 1,000 kg of buffer stock, regardless of the quantity order. It means that the closing stock is 1,000. The opening stock is also 1,000 kg. If you add, if I do like this, desired closing stock, 1,000 kg, add 1,000 kg. Opening stock minus 1,000 kg. Minus 1,000 kg. I've only put this to explain. In the exam, once you see that examiner says the usage of material will remain constant, you don't need to bring in opening stock and closing stock. Your opening stock is the same as your closing stock. Is that clear, please? This will be minus. That means I'm still going to have my figure back. Material purchase before waste. This will give me 47,500. This will give me 31,500. kg. I will now introduce this material. I will now introduce waste, if any. Let's go to the question. Look at it. Material T wastage in percentage. 5% will be the wastage for under product K. 10% will be wastage under product L. That means if we purchase material, we are going to purchase 100% material for product K, out of which 5% will go waste. That means only 95% is used for production. For material, for product L, we are going to purchase 100% material. 10% will go waste. That means only 90% is used for product L. We can now determine our waste. The same thing we did here, we can just come here, working under this place. Please allow me to go a bit down. I can now come and say, okay, waste. Work into. Waste. No, this one is our. Let's see.
Material waste.
Yeah, material waste or wastage for K, 5% will go bad. That means remaining one is 95%. 5 over 95 multiplied by
47,500.
47,500.
Thank you. 47,500. What do you have, please?
5,500.
2,500 kg.
Yes, sir.
You go to the next material. For lay, for lay, 10% will be
10 over 90.
10 over 90
Times 31.
Times
multiplied by
31.
Times
31,500. That's
that will give us what?
3,500 kg.
kg.
3,500 kg. You can now add this now, plus, this is plus 2,500. It plus 3,500. Total year.
50,000.
Total year.
35,000.
50,000 kg. We have
And 35,000 kg.
35,000 kg. Oh no. Kg. Total material T. This is total material, total purchase. For material T total, material T, because it's the same material. Material T total is equal to 50,000 plus 35. It is this, we are adding because it is same raw material. Please note, I'm adding
But
the
different
two
products,
materials.
sir.
What do you say, please?
I said the same material but different products.
Yeah,
Is
thank
that?
you. So if you are going to market, we are going to buy 85,000 kg of material T. 50 will be used for product K. 35 will be used for product L. Is that clear, please?
Yes, sir.
Yes, sir.
So the only reason why we added was because the same material is used to produce the two products. But if you have different material, you can't add. Oh. Is that
Okay,
point
sir.
clear? Aha.
Yes,
So
sir.
before we round up this,
Okay, sir.
the question says calculate material purchase in kg and in naira value. The question says calculate material purchase in kg and in naira value. So we need to expand this small. Very well said, because okay. Let me take this off. So I cannot come here. Material T purchase. Material T purchase budget. Naira value. This is equal to 85,000 kg. What is the material price per kg?
30 naira.
30
Can we all
naira.
see it? 30 naira
30
per
naira.
kg. Please multiply. What is naira amount?
2.4 million.
2 million.
2,550,000.
550,000.
It's not 2.4. 2,550,000.
Yes,
Uh-uh.
550,000.
550.
Yeah,
it comes
2,550. How can you get 2.4 when it's not 80,000? It's 80,000. Okay. Sorry.
No problem. It's an error now. We are now done with requirement B2. You are done with requirement B2. Look at it. Purchases budget for material T in brackets in kgs and in value. Then lastly, calculate the economic order quantity for material T. This question B is not part of budget. The question is under inventory control. I'm not sure you have started working capital management.
We started yesterday.
We have, but
yesterday.
we've not
We did
gotten to
yesterday.
this.
Okay, the one will still take you economic order quantity, but we can solve this question. Economic order quantity is that quantity of material order that will minimize the total cost of the company. To calculate this.
Sir, please, could you come again on that? You said
You come again, sir.
Kindly come again
The
on the
explanation
definition
of
of
economic
EOQ.
order, sir.
People have a plan.
You said is the quantity of material order that will mean the what?
Okay, let me explain this. Economic order quantity. This is the quantity of material ordered that minimizes the total cost of inventory. This is the quantity of material ordered that minimizes the total cost of inventory. It is calculated with the formula that is my B. Economic order quantity. The formula is square root 2 multiplied by D multiplied by CO multiplied by CC, where your D is
annual demand.
Annual demand for material. In this case, the annual demand is 85,000 kg. That is what we require to purchase. Is that not totally?
Yes, sir.
Then your CO is the ordering cost. The ordering cost per order. In this question, the examiner says 30 naira. Look at it. The cost of placing order is 30 naira per order. Your CC is the carrying cost. The carrying cost, we also call it or the holding cost. The holding cost per material. Go back to the question. Annual cost of holding 1 unit of raw material in stock is 17% of the material cost. What is the material cost? Material cost is 30 naira per unit. Is that not? Or per kg?
Yes, sir.
Our
Per
CC
kg.
is 17% of material cost, 30 naira per kg. Please compute. 5 point what?
5.1.
5.1.
You have gotten all the variables required. You can get your 5 marks. Yes, ma. Economic order quantity is equal to, draw your square root first. 2 multiplied by D, 85,000 kg, multiplied by CO, 30,
30.
divided by CC, 5.1. Final answer, please.
1,000.
And answer is 1,000 kg. At any time we want to place order for material T, we must order 1,000 kg until we complete 85,000. This will minimize our cost. Any question, please? We can go for a break now. It's 1 o'clock.
Thank you, sir.
Thank you, sir. Sir, please, will the
Thank you, sir.
recording be available immediately?
Thank you.
Yes, the working will be shared immediately. But
No,
the
I mean the
video,
recording.
the recording,
Yes, please.
the person in charge, that is our secretary. We have to bring the recording out. And she has
So
a
when
lot
are
to
we
do
expect?
because hold on, because as I'm taking you now, some people are doing other subjects at different classes. So she has a lot to record. But once it's ready, I will ask after the class. Is that better, please?
Okay, sir, please. Because some of us were having network issues going out and coming back in.
Or it's understandable.
Quite important.
All right,
Thank
so
you.
Ekpele.
Bye.
When
Right.
are we supposed to come back, sir?
For the break,
I
Governor, you will come back.
come back where?
Maybe you'll be the one who wants to come back.
We are having running.
It's a question now. Why are you
Better
fighting me?
understanding.
That's yes, after the break.
Okay.
We meet on Sundays by God's grace.
Amen.
All right, sir. All right, sir.
Hopefully not
Thank you,
online.
sir.
Bye.
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 Black